CPI print in the US came in this morning at 2.9%. That's the lowest level since 2021. And that data, coupled with the latest retail sales print, also issued today, which showed an increase of 1% through the month of July, has stocks and bonds on the rise. We've got this volatile, very interesting, positive news, seems to be positive news going on right now. So with consumer spending holding strong, are all worries about an economic slowdown completely out the window? And what is the benefit of our next guest investing style through these market conditions? Joining me now for a look at where he is finding opportunities around the globe and for an update on Fidelity Global Intrinsic Value Class is Institutional Portfolio Manager Naveed Rahman. Hi, Naveed. Great to see you again. How are you?
Well, thanks, Pamela. Great to be here.
So glad that you could join us on every day, and I'll invite everyone to join you by sending their questions in here on any day, but it's just a really interesting day for some of the data that's coming in right now. The consumer appears strong in some of these latest prints. You've been a bit ahead of the game on really looking hard at the consumer for some time and investing actually ultimately in the consumer sectors. Let's go there first. What did you see and what did you like, and why do you think the consumer is good or bad in this sort of market environment?
Sure. Again, we are overweight both the consumer sectors, both staples and discretionary. Obviously, we're not investing with a specific expectation for a certain CPI print, but it is helpful to the consumer that inflation continues to trend down. It is helpful to the consumer that employment remains quite robust, maybe not at the peak levels they were around the world a year ago, but still quite healthy. And for us, from an investment standpoint, Pamela, what I think is interesting is that the stocks were in many cases already pricing in this sort of long expected recession. So, we are finding reasonably priced, high quality companies at 8, 9, 10 times earnings. And
Wow.
so when you see that, sort of like many of the more dire situations are already priced in, and there are a couple of places in consumer that are especially appealing to us. The auto parts area in particular is one of those subsectors. A lot of those companies, Pamela, are trading at sort of trough valuations on trough margins. So that, again, just it's not for the faint of heart. It's not as if they're going to inflect positively, in a straight line, but you are really seeing a through cycle value in that sector. We own some frozen food companies in the portfolio, very defensive. Should the economy, slow down eventually, these are companies that should actually power through quite well because it is sort of these are companies that offer really good value to the consumer, and that sort of syncs up with our investment process.
It sure does. It's in the name of the fund, the Global Intrinsic Value Class, and we'll get right into the exact style of that in just a second. But I want to ask, through the recent market volatility, which, I mean, to some extent, today is a new day, isn't it? Looks like all that stuff we saw last week. I don't know, maybe it wasn't as dire as we thought. But tell us how this fund performs through, kind of massive swings that we saw last week. And now maybe everyone's feeling a bit more positive about things, but it's very difficult to walk down the middle of that. How do you try to do that? And, what's the history of the fund walking through these rollicking markets?
Yeah, absolutely. Excellent question. And so we have taken a very consistent approach where we marry reasonable price with high quality. So we are not trying to find the cheapest absolute values around the world. Like, cheap is not enough. Cheap is not value for us. It is really attractive valuations plus companies with above average margins, consistent free cash flow generation. The positive outcome of that is almost in every downdraft that we experience, every period of volatility like we experienced only a month ago or only 3 weeks ago, this is a portfolio that provides really fantastic ballast. Over the last 3 years, our downside capture is about 48%, and our upside capture is 85, 86%. That's extraordinary for an equity portfolio.
Just say that again. That's
sorry. Downside capture about 48% and upside capture about 85, 86%. It's extraordinary in an equity portfolio. We almost have, and I don't want to, this is not promissory, obviously, but that almost has like a balance fund type, dimensionality to its downside capture. And
And a
again,
balanced fund is, roughly 40% bond, 60% equity. So
correct.
yeah.
Yeah. So again, it's the companies we invest in, whether it's the consumer sector or healthcare or tech, they are companies that have inherent defensive qualities, but also participate when things revert back and sort of they are earnings growers. We are investing in companies that have underlying earnings growth to them. They just really also have a very stable margin profile. So when things turn sour, they tend to hold up much better, and the investors gravitate towards these companies.
So again, when you see the markets take a dive, and it's been kind of weird because we've seen the overall S&P, because of the outweight of the Mag 7 and so on, take a tumble, even though there's a broadening process. Just speak to that, because again, how do you invest that? How does the fund handle things where you kind of got a falling market, but a broadening at the
Right.
same time?
Yeah, and I guess I would highlight that, our investing sweet spot is reasonably priced small and mid-cap companies. So on many dimensions, when you think about the market dominance of the Mag 7 the last 3, 5, 7 years, this is a portfolio that's really complementary on multiple dimensions. The Mag 7 is large cap US tech. We are small and mid cap, more value, more global, and not dominated by technology. We have, as we said, pretty large allocation to the consumer sectors. We have a fairly healthy allocation to really resilient businesses in the healthcare sector. And so it is a more diversified portfolio, not sort of dominated by a single sector like technology. And really, yeah.
Do you have Mag 7 stocks in there? I mean, just to sort of fan out that idea that you could have this as a complementary.
Right. It is really complementary. We own none of the Mag 7 stocks in the portfolio. And again, many of these are fantastic companies. They're highly profitable. They're also priced as such. And so we are always looking for where there is a disconnect between price and value. And we have technology holdings, but we own technology companies that are to some degree second and third beneficiaries of sort of the AI investing theme. So if you think of companies like a Seagate, which makes hard disk drives, all the server farms that are proliferating to support the AI workloads, they need storage. Companies like Seagate provide the storage. Again, it is not a first order beneficiary of this fantastic investment area that the market is really interested in, but it is a really interesting secondary beneficiary. And we have a couple of those sprinkled around the portfolio.
Fascinating. Okay, we'll dive back into some of these pieces. Let's go global for a minute. You are experts on Japan. You have been investing in Japan for a very, very long time. We saw a massive hiccup, saw the yen rise, which can be tricky for some of the Japanese equities. Take us to what we know, what the unwind was to an extent at this point. We've been able to look at it, but what's still left there that you like to invest in, and what is this moment like for Japanese equities?
Yeah, absolutely. And before the turbulence of the last month or so, it had been a meaningfully outperforming part of the global equity market, and it's gotten some of it back now. But so we've had a lot of success investing in Japan, primarily in smaller mid-cap companies. And so the first point I'll make, Pamela, is that when the yen strengthens, which it has been the last month or so because of the actions of the Bank of Japan in relation to the other central banks around the world, on balance, that's harder for large cap Japanese companies that are exporters. We are typically not invested in the Toyotas or the Mitsubishis of the world. We are in smaller mid cap companies, pharmacy companies like a Cosmos Pharmaceuticals or an Arata. These sell into the Japanese economy. They're more domestically focused. And like the other companies that you will see in this portfolio, they provide tremendous value. We own a number of consumer-oriented companies in Japan that have a similar operating efficiency to a company like Walmart in the US, which is extraordinary because these
Wow.
are companies that are maybe 1/20th the size, but have a lot of the scale advantages that somebody like a Walmart has from an operating margin or SG&A as percentage of revenue type perspective. And so the market itself has been a pretty good fertile ground, and we have really outperformed the Japanese market by strong
Really?
security selection there. Now, I will just say that until the events of a month ago or so, Japanese equities were outperforming. So our style is to take profits when that is happening. And then they had this big retrenchment. So we're obviously sharpening our pencils and sort of, I'm not liberty to speak to the individual companies, but we are fishing in that pond because the value has all of a sudden gotten a little bit more attractive, right?
Fascinating. So exciting. And so exciting to sort of hear the opportunities of that maelstrom, I think maybe we could call it.
Good
A couple
word.
of questions coming in here. So let's just go to these and we'll circle back to some other things. So Naveed, do you think that we're going to see a rotation, maybe we're already seeing it, from growth to value? Speak to that if you don't mind.
Yeah. So it is a $1 trillion question. So I appreciate that someone is asking, and it's on many investors' minds. Um, the indications are yes. The timing and sort of the path of that is really the uncertainty. And a couple of things support this argument. First, the spread between growth and value and even sort of mega cap stocks and small cap stocks is extraordinarily wide. And so that is often by itself a catalyst for mean reversion. So that would be point one. And then point two is, if we are in a higher for longer interest rate environment, which seems to be the case, and we'll see how this plays out the rest of this year into next year, but that's a better environment for value-oriented investors. There are more cyclical, rate-sensitive sectors in our universe, if you will. So financials, industrials, energy, these are all sort of do better in a higher rate, more inflationary environment. That's a bigger part of our universe. And then lastly, growth stocks, especially sort of the more speculative ones, have benefited from the low rate environment. And so the fact that rates are higher and don't look to be going back to zero in the developed world anytime soon, like this will just be a higher, more challenging operating environment for sort of unprofitable, fast growth type companies.
Really interesting. So there are a lot of people that have been watching very closely small caps, basically, as a group, because of the interest rate story. And we sort of know what they should do. And they had a pretty spectacular performance sort of through most of July. That said, you're sort of in mid small cap within the US. I guess just sort of fan that out a little bit more for those that might want exposure to, if you pull it out of the air, small caps. What might the fund do for those
Yeah,
investors?
we provide a very healthy allocation to small and mid cap stocks. I mean, I think 60 to 70% of the portfolio is invested in that part of the market. And there are two things that I think are worth mentioning there, Pamela. One is that it has been out of favor. It is coming back into favor as sort of the overall growth value trade is happening. Part of that is the small cap beneficiary. Um, Second point is that if interest rates do sort of head down a little bit and normalize at a maybe 3-4% type environment, that's better for small caps, which tend to be more leveraged and benefit from interest rates coming down. Their operating environment improves, their cash flows improve. So that's another tailwind to small caps. And then the last thing I'll say is that it's a really fertile environment for active managers. There are, in the US today, almost 40% of the members of the Russell 2000 are unprofitable and consistently unprofitable.
Wow,
So
40%.
we at Fidelity have the research to pick and choose, figure out the companies, avoid the ones that are sort of perennially unprofitable and sort of are uninteresting parts of the market to be invested in, and redeploy in consistently profitable companies. We will occasionally, dip our toe into a cyclically depressed company where we see a line of sight to improving cash flows and earnings. So you get the benefit of active management in a space with a lot of stocks you want to avoid if you can do your research and be particular about what you invest in.
Fantastic. Another question rolling in here. So let's take a look at this. So how will Naveed soft landing versus hard landing? Today it looks like a soft landing, but not so last week. How will that sort of dichotomy, soft versus hard landing, impact value over the longer term?
Yeah, it's a difficult question to sort of, answer in a pinpoint way. So it really, I guess, we think of it, well, first of all, we try not to obsess over like predicting the macro outcomes. It's extraordinarily difficult, and the timing is notoriously hard. Um, but secondly, we really try to invest in companies that can control their own destiny, generate cash consistently, and grow through a cycle. So, whether we have kind of a soft landing, hard landing, we want companies that can navigate in both environments. And so, we're in a way we are a little bit more agnostic. Now, the one thing I will say is historically, financial recessions and non-financial recessions are very different. So that's one thing to actually keep in mind.
Are you
We have
concerned about a financial
we are
recession?
not. I was
No,
going to get there. Yeah,
no.
we are not
Yeah.
especially concerned. So, charge-offs in consumer credit companies around the world are at very reasonable levels. Um, Bank lending standards are fairly tight. This is not in our mind. We are not seeing kind of a replay of 2009, 2010, when lending standards were extraordinarily loose, or 08, 09, and the consumer was very over leveraged, and that sort of had a magnifying effect on the recession. So that's not what we see. We have a healthy exposure to the financial sector, not an overweight. We prefer the opportunities in consumer, like I said, in energy, like I said, up to that. But that's one important distinction that you want to sort of keep in mind. If you anticipate a financial recession, you really want to be positioned in a different way, and that's not what the bottom-up research is telling us at this moment.
You mentioned energy there. I might put this together with the next question coming in for you here. Can a value rotation favor sectors such as materials? Maybe we'll just include energy to sort of broadly look at commodities. Yep.
Yeah, for sure. And we invest in sectors like energy, materials, again, without trying to be really cute and predict, is Brent going to be 85 this year and 90? It's extraordinarily difficult to know that. But we are invested in energy companies that are generating robust free cash flow at today's energy levels and remain free cash flow positive, even should the oil price, hit the mid 60s or below. So, we want to have a big margin of safety investing in energy and materials, because this is a notoriously volatile part of the market, as we all know. So we demand a bigger margin than we do in the consumer staple sector or healthcare or other more defensive sectors. But we really do see, there are a number of the big investments that we have free cash flow yields that are 8, 9, 10%, which means you're sort of getting the entire value of the company in, call it, 8, 9 years in free cash flow. So we want companies that have that kind of free cash flow profile, and where the management is committed to not squandering the free cash, because that's the thing you're always worried about in energy. An unscrupulous energy CEO will sort of take that free cash flow and buy a competitor, or do some other sort of empire building. That's not what we want. Our energy thesis is predicated on tight energy supply and demand for the next 3 to 5 years. But we are fully aware that the longer you look, the more there will be pressure on energy demand from the carbon transition that is happening around the world at different paces. So it is not a forever buy and hold. There is a shorter leash on that, but we are overweight there. We are constructive in the medium term, and it's really about stock picking, not buying the whole sector in this case as well. And that goes for materials as well.
And there goes for GS as well. Let's swing back to consumer, because it is just so interesting, and it's something that's been a bit of a thread through the discussion here. Across discretionary and staples, the discussion of a trade down consumer has been in the markets for some time. It's not new. And in fact, some of those kind of household names have been bid up because this trade down is sort of well known.
Yeah.
Can you take us inside there? Because are you holding stocks that are actually have been bid up, or are there other opportunities within? Take us inside the consumer.
Sure. Yeah. The obvious beneficiaries of the trade down have, to your point, Pamela, been bid up. The price, or the discount retailers are trading at 25, 30 times earnings now. That's not where our positioning is. We have taken profits from those parts of the market. And part of the reason auto supply is super interesting to us is that, auto sales have been sort of, not through the roof, not very low, but not spectacular either. And we are really sensitive to be exposed to consumer names that that are offering value to the discerning consumer. We Walmart reported today very strong margins, growth. That's not surprising to us because that is an overall sort of the overall trend. I mean, the market is also. I think Walmart is probably trading closer to a peak valuation versus versus the market, 25-30% valuation premium to the market. So those obvious beneficiaries, I feel like, are actually pretty well understood and pretty well priced. So we are really looking a little bit more off the beaten path. We have some exposure to housing-related consumer names, and housing has been sort of in a stall zone, kind of in many big geographies around the world. The interest rates being higher for longer than people expected has certainly put a damper on housing. But and we're seeing a lot of value in companies that supply into the housing sector. They could benefit if the Fed cuts interest rates down the road here and joins kind of Canada and Europe in doing so. You don't need a massive reacceleration, but just if the trend gets a little bit better, that should benefit housing related names. And we are seeing really attractive valuations in some parts of autos and housing, different from sort of discount retailers, which are already bid up as we discussed.
Oh, that's great. Yeah, really, really interesting sort of insight into how that works. We went global. We talked about Japan. Anything else to know about again, the name of the fund is a global fund. Tell us where else you find some interesting.
Yeah, I mean, I think probably we're excuse me, we are finding value, the intersection of value and quality in Asia outside of Japan. That's a really interesting. There are a lot of companies in those areas that are interesting to us. We have been overweight parts of developed Europe, and continue to find value there. And I think our long-standing underweight in the U.S. remains. Again, it's the biggest part of the index. On an absolute basis, it's the biggest country that we have an allocation to, but we're also 17-ish, 100 basis points underweight the U.S. Just it's had the most number of outperforming small and mid-cap stocks globally. So there's a lot of quality, but not so much value. And so underweight the US, overweight Europe, overweight Asia. Those are sort of probably the biggest, in addition to Japan, that I would highlight.
Okay. There's been some, again, I'm using the word spectacular again, but there's been some sort of spectacular leadership changes actually within consumer, and discretionary specifically. More as a broad statement, we are getting past this COVID period. We're normalizing, the macro backdrop is normalizing. Do you see ongoing leadership changes sort of coming down the pike, and ultimately what it means for you? I'm just sort of asking for an observation. You obviously focus on management very closely for everything.
Sure. Yeah, the most notable one was Starbucks got a new CEO earlier this week, and Chipotle lost one. Quite seismic. I think what we're observing is that, to your point, it has been a difficult operating environment for companies broadly, but consumer-facing companies in particular, with the pandemic, the lockdown, the supply chain issues, the debottlenecking of that. The thing that we've observed is that the better managed companies have really separated themselves from the kind of more average or probably less well-managed companies, especially in the consumer sector. And the stocks have really gapped out. And so, it's obviously difficult to predict when these things happen, but we are not surprised that, there are changes happening, and I would not be surprised if there are more afoot. There are a host of companies that were considered the better consumer managed companies pre the pandemic that have not kept up and that have really fallen behind. And there are a couple in particular that I'm watching where the valuation is pretty interesting. There's a possibility of a management shakeup that could be a further catalyst. And we really lean on our analysts who know the companies well. We interact with the board of trustees of these companies, when they want to sort of check in on the investor perspective of sort of the overall quality of the management team. So we do have a trusted line of sight. We don't know material information before it happens, of course, but we are a trusted partner and a long-term investor in these companies. And I would not be surprised if there were, a couple more changes like this afoot as the year plays out.
You've said before that almost as a byproduct, you're going into companies that are value, sort of are priced attractively, and it does happen sometimes they get taken out. I mean, which ends up being good for the portfolio, but it's sort of as this byproduct discussion. Again, leadership change, but also takeouts. Do you sort of
and
feel like that kind of cycle right now?
Right. That happens quite often. Almost every quarter, I think something we own is rumored to be taken out or actually gets taken out. In our recent history, that happened with a chemicals company called Univar that was taken out by Apollo that we owned in size. We have historically had a position in Discover Financial, which is being taken out by Capital One. That was announced earlier this year. It happens frequently, Pamela, because what strategic buyers look for and what we look for are actually fairly well aligned. A strategic buyer like a Blackstone or an Apollo or some other alternative asset manager, they want high quality companies that can grow, which with maybe operating improvements could grow even faster. They're not looking, to pardon the French, but they're not dumpster diving for like the worst companies at the most bargain basement prices. Most of the time, those companies don't have a growth trajectory in their future. They have too high levels of debt to begin with. And so the combination of reasonable price, high quality, a line of sight to growth, that's what strategic buyers look for. So it is not surprising that we end up holding companies that do get taken out more often than not. It's not part of the thesis, as you say, going in, but it does happen more often than not. And, knock on wood, it'll continue to be the case going forward for the global intrinsic value portfolio.
Let's just finish out with something you said earlier that kind of, that whole idea of being complementary at a time like this. So just kind of go through a little bit of the performance through many, many different types of cycles, downside capture, upside capture. But that idea of being complementary to these really heavyweights within the S&P 500.
Yeah, absolutely. I mean, when you have a downside capture like a 48 or 50% downside and an upside in the 85% range, what we should keep in mind is that this is the kind of portfolio that really fits in nicely with other equity and bond portfolios, because typically when that downside capture is happening and we are outperforming, most other kind of high beta portfolios are underperforming meaningfully, right? So if I'm an asset allocator, what I want are alpha generating portfolios, but where the alpha happens in an uncorrelated fashion. If I have a client that I'm managing money for with 10 equity portfolios, I don't want them all to be outperforming at the same time and underperforming at the same time. A portfolio like ours will look very different in its performance cadence than most other global or domestic equity portfolios. And that's, to me, that's the secret sauce. You want alpha, but you want the alpha to be as uncorrelated as possible to most other active and passive portfolios. And that's been our history. And I think that's why we've had success, not just in Canada, but in the US, in Japan. We are this really interesting complement to most other equity portfolios.
It's a delight to speak with you. As always, enjoy the rest of your summer. Naveed Rahman, thank you for joining us.
Thank you too much for having me.